All right. Okay, teammates, welcome to the MMC University. My name is Ernest. I'm going to be your host for today with you. We're going to talk about Florida statute rules and regulations. This is, you find this in chapter 6. We're going to cover some stuff with you guys. Let me see if I can move this out of my way so we can get this started. And when you're watching this video, so wherever you are on the Zoom land, welcome again. So we're gonna do the best that we can to post those videos for you guys, so you can hopefully that can help you pass the exam. So everything we're gonna be covered here, I cannot say that we're gonna guarantee for you to sit on your exam, but most likely it could be tested. All right. So let's get this started. So the first thing that we're gonna be talking about is what we call marketing practices. All right, let's talk about that. Specific regulation of which agent should be aware of. We're going to talk about what you as an agent, what you should be aware of. Okay. First thing that you need to be aware of is what we call Florida. Let me see if I can point that out. Florida life insurance solicitation law. So this is information and procedures that require when proposing life insurance to a prospective buyer. So that's what that rule going to talk about. The second rule that you need to talk that we're going to talk about is what we call the Florida replacement rule. So this is another rule that's the requirements, okay, and procedures to be followed when a prospective buyer will be replacing an existing insurance with a new insurance policy. All right. Also, last we're going to talk about what we call Code of Ethics of the Florida Association of Insurance and Financial Advisors, which means it's establish an outline of appropriate and inappropriate business behavior for insurance agent. Establishes the activity of agent as one of the public trust. Okay, so now let's look at them for just a little bit. Let's talk about them for a little bit here. So when we talk about the Florida life insurance solicitation law, so you see this is where information, and which is what called and also procedures that what we need to follow when it comes to selling insurance to someone. Okay, that's what this law is about. Now another key point I want to show you here: replacement. When you see the word replacement, you have to think of that's when somebody have something before, now you're going to replace it. That's when an existing thing's going to replace with the new things. So that's when there's an insurance policy that's already there that's going to be replaced. So if there is no policy in place, so there's no replacement. Okay, but we're going to also cover what replacement actually really meant when it comes to insurance. But I want you to think of the word replacement. So that's when that person has something, you're going to replace it with a new. So look at this keyword existing, okay, and new. So those already give you the signal of the word replacement. All right. When they talk about a code of ethics, ethics kind of should know like right from wrong, know what's right, what's wrong, okay, your behavior, okay. But now look some of the keywords. It's outline. You look the word appropriate and inappropriate behavior. When you see those words, they referring to ethics. Okay, so those are some keywords that you need to, so you don't confuse those rules. So if you see appropriate, inappropriate, don't pick replacement rule they're talking about. You should know they're talking about the ethics. All right. So make sure you really make that difference right there. So now let's talk about some disclosure. Okay, let's say now we're going to talk about, because now you're going to do solicitation. That's when solicitation means you're going to selling somebody a policy. Now what that's called, I'll put this like before you buy. Okay, before you buy, it's just like if you're going to buy a car, you don't just go buy a car. You go there and you meet with the salesman, and then they give you a tour or whatever, blah blah blah. They talk, you know what I'm saying? Try to sell you out. Okay, that's called the buyer's guide. So let's talk about those two disclosure: buyer's guide and the policy summary. Now, Buyer's guide, put it this way, that's before you buy. Before you buy. Okay. And policy summary, after you buy. Okay, so that it's simple things that, little things like that for you to understand what those two terms mean. Because sometimes a lot of people confuse. Man, when should I pick the buyer's guide? When it is the policy summary? So when you're going to buy a car, for example, okay, when you go to the place, to a dealership, let's say you go to Toyota, for example, and the salesman say, listen, we have this car here. It's a Toyota 2020 or maybe 2021. We have this feature, this thing. So it get just, and in general, he give you a guide. He show you different cars and this, but you don't buy anything yet. So he just show you. And sometimes you go to a bike, he pay here, and you're gonna see there's a sign or maybe a piece of paper, okay, white sheet of paper, for example, and it can be like this, and on the window it say as is, or maybe no warranty on it. So that's a guide to already give you a guide about this car. Okay, that's before you buy. Know before you buy. Okay, then after you buy, you need to know, okay, know after you buy what should you be doing, what you should not be doing after you get that. So that's what really those two things really about. So let's talk about the buyer's guide. The buyer's guide and the policy summary must be given to the applicant. Now, remember we're talking about applicant. If we watch the previous videos, an applicant is somebody that's not already a client yet. So that's somebody who's applying for the coverage. So an applicant no later than the time of the application is signed. So in order for you to give them the policy, the buyer's guide and the policy summary, you have to make sure you cannot give it to no later than the time of the application is signed. But later on, you're gonna learn some stuff, some exception, and so why not? And we're gonna do the best that we can to cover those as well. So the buyer's guide contains generic information. Now look at that, general information about life insurance policies. So they're talking about, like, let's say they're talking about group, whole life, talking about term insurance, variable life, or universal life, you name it. So they just give you something in general, but they not give you anything specific. So make sure you understand a guide is something that's general information, just like what we call basics information about insurance. That's what the buyer's guide does. That's mean before you buy, you give them a guide. So the second thing is the policy summary is written statement. So now this is written statement that describe the elements of the policy and include the key features, condition, and restriction of the policy. So now, if I was putting this in my word, they say the policy summary is now it's talk about specific stuff. Okay. Like now you're gonna know exactly how much you're gonna pay. You're gonna know exactly how long is the coverage, how much is the coverage, when the payment is due. It gives you specific information. For example, let me just give you a scenario with those two things. If I say that go pick a car, do you know which car I'm talking about? There's a bunch of cars in the parking lot. I say go pick a car. Would you know which car I'm talking about? No, you will not know which car I'm talking about. But if I say go pick up the Toyota, you're gonna see a black Toyota 2010. This is the VIN number. Now you know exactly which car I'm referring to because now I'm being specific. See, now when you're buying insurance, okay, so there's general information that's before you buy, and policy summary is after you buy. You're gonna know exactly what's in that plan. That's where you're gonna make sure you get that. So now let's talk about, it's not in here, but let me just remind you, since we talk about chapter 1 about that. So when it comes to the Florida rules and regulation, so the buyer's guide, you have to give it before. That's mean before you collect the initial premium. But what happens if I don't have the buyer's guide? So what should I do? Should I do the policy? Should I give it the client? What do I do? So now, as long as, now listen to me carefully, as long as the policy contains 10 days or more, 10 days or more of free look period, you're talking about the free look, that's mean you can look up the policy for free 14 days. Okay, as long as you have at least more than 10 days free look, you can give them the buyer's guide when you deliver the policy because they still have a chance to look at it for free. They can return it for a full refund. So that's one exception to that rule. So now I have to give them I understand that I need to give them the buyer's guide before I collect the first premium from them. But if I do not have one, as long as my policy have a 10 days or more free look period, so I can give them the buyer's guide when I'm delivering the policy. That's been with the policy. Make sure that's a good note for you on that exam. All right. What about the policy summary? Well, the policy summary, you give it to them when you deliver the policy as well, because the policy summary contain, specific information. So you give that to them when you deliver the policy. All right. So let's talk about life insurance solicitation. So solicitation regulation, okay, is provide buyers with information that will the buyer select, okay, the most appropriate in the policy, understand like features of the policy, and evaluate the cost of comparable policies. So sometimes the person might want to shop around, they want to check, the price, the features, what's inside this policy. So that's why that they will talk about. That's why you got to make sure you talk to the client about those things prior, so they can have a chance to do, their due diligence, whatever they want to do. All right. So life insurance solicitation regulation does not apply to annuities. So that rule, there's some type of product it does not apply to. So when it comes to annuity, it does not apply. Why is not applied to annuity? Because annuities are not life insurance. So they're not life insurance. Okay, credit life insurance. Now, credit life insurance, it's kind of type of life insurance, but that's what for people that borrow money, that buy things on credit. So they put an insurance on that person. So that's called a credit life insurance. So the rule does not apply to credit life insurance. Group life insurance is something you do with group. So therefore, it does not apply into that situation. So group insurance, those are another exception. Variable life insurance policy, okay, it does not apply. Now, I could see why variable life insurance may not be into that, even though it's a life insurance, because there's part of it that's such investment as well. So they will say, it doesn't apply to this type of insurance. Also, life insurance issue in connection with the pension. So there's some people that might work in a place, they got a pension plan that come up with the life insurance. The rule does not apply to that as well. And also some welfare plan. So you need to know what the rule does not apply. Okay, now, so if that's everything else is applied to, right? If somebody have a term insurance, the rule come to place. If somebody have a whole life insurance, the rule get to place. If somebody have a universal life, okay, it get to place. So those are the exception. So make sure you be careful with that as well, okay? Because they might ask you a question, which of the following the solicitation rule regulation does not apply to, or which of the following the rule apply to. So you need to be careful how you answer that question in here, all right? So we're going to talk about prohibited practices. So there's some stuff that you can't do. You cannot do everything. You cannot do whatever you want. This is not a free land where you can do whatever you want. Now, I'm not saying you cannot do things, but there's some stuff that you cannot do. So that's called prohibited practice for marketing of life insurance policies. So when you're marketing yourself out there, so there's some things you cannot do, and I'm about to explain some of them to you. Using like misleading means not things that's not accurate. So that's you misled or mislead the client. Okay, using misleading terms such as financial planner. Can't say that. You cannot say, "Oh, I'm a financial planner." No, you're not. Don't say those words. That's misleading. Investment advisor. If you don't own the title, don't say you're an investment advisor. Okay, financial consultant. What's that? So make sure you don't use those terms or similar term to imply that agent is engaged in advisory business in which the compensation is not related to the sales. So make sure you be careful how you pick words to put on your marketing business when you're going out there to start doing your business. All right. Also, false information in advertising. Insurers may not make, publish, circulate before the public any advertisement or statement with respect to the insurance business that is untrue, deceptive, or misleading. So it doesn't matter what company at the so you cannot advertise or circulate information that is not true or deceptive or misleading. So that's simple things to understand. Advertising gift. Insurer, which is the insurance company, or its agent, that's including the people that, like you that's taking this class, that's going to sell policy. You cannot give any item for the purpose of advertising that has a value of more than $25. So you cannot do that because as is $25, we talk about with dating. So make sure you be careful. The advertisement may not be more than $25 unless the rule are changed. So those numbers can be changed. Hopefully they don't put it to $100. Now you don't know. So make sure you double check that as well when you're reading the will book because numbers change. Free insurance. Okay, offering free life insurance for either the sales of a purchase of a personal property is prohibited. So free mean what? Free. So you cannot telling people that you're selling them free insurance. When they come in, they have to buy this water, they have to buy a water, or they have to buy an iPad in order for them to get the free insurance. At that point, it was not that's a trade-off. You give them something for something. So this is no longer free. That's a transaction. So at that point, so if it's free, make sure it's free. That's prohibited practice. So don't do it. All right. So let's talk about annuity. And I apologize if it's me drinking water. Let's talk about annuity suitabilities. Now, we talk about annuity in chapter 2 when we're talking about type of life insurance. Now, you know, annuity is the opposite of life insurance. So people buying annuity, again, is to for retirement. Okay, people that want to save money for later on so they can use. An annuity can last for the life of somebody. Okay, which is, it could be great products. It depends how the person feel about it. All right. So now, to ensure that annuity transaction are in the best interest of the consumer. That's what we're talking about suitability. So not everything is suitable for somebody. If you tell me to do this, why is it good for? What is that suitable? Is it why that's recommendation? Why you recommend me this product? So make sure it's in the best interest of the consumer. Producers, which is we're talking about us, the agents, producers must make a reasonable effort to obtain relevant information so from the consumer and evaluate the following factors. What's important when you taking out the suitability of for somebody that want to get an annuity, okay? Make sure you check the age. Age is a big factor in that. Annual income, how much does that person bring home? Financial and tax status, which is, that's the reason for that, okay? Because annuity is something that's long term. Investment objectives, what do they want? Liquidity means liquidity needs, how soon they might need money. Okay, if they're gonna need money the next year or so, you may not be suitable for them. Liquid net worth, so how much money those people have available in the net. So that's, again, those are things you have to make sure you take in consideration. Indeed, use of annuity. Okay, the use of annuity. Also, financial experience. Do they have any experience into the financial arena in the marketplace? And also their risk tolerance, how much risk they can tolerate. Okay, because some people can take moderate risk, they might be conservative, they might be, aggressive. So you have to know that person risk tolerance, because you have to be careful when you recommend those type of products. So those are some key points for you to know about annuity. So senior consumers, seniors, you're looking at somebody who's like 65 or older. So a senior consumer is anyone the age of 65 and older. So if you're selling for that person, so be careful, extra careful. The insurer or agent has no obligation to the senior consumer if the consumer refuses to provide relevant information as requested. So if you're talking to the senior and then I give you the right information, okay, so you as the agent or the insurance company, you have the obligation to the senior. Okay, if they're not giving it to you, you can refuse this to provide. If you can refuse. Hey, if they want to move along with the products, hey, listen, you didn't recommend that, they didn't give you the right information. So that's a big deal. So make sure you can collect as accurate information as possible, and you have to let them know those information must be like as accurate as possible in order for you to make a good recommendation. So annuities sold to a senior consumer may not contain a surrender or defer surcharge for a withdrawal for more than 10% of the amount withdrawn. So like if somebody come in doing annuity and you sold that to a senior, okay, consumer, so that may not that may not contain, okay, a surrender or defer surcharge. That's mean defer mean later to charge them, okay, for withdrawal for more than 10% of the amount withdrawn. So if they ask you for some numbers, make sure you know it's 10%. All right. So agent, but remember also it's for seniors. Agents and insurer must maintain record on recommendation and sells products to senior consumers for 5 years after the transaction is completed. So when they do that, teammates, you have to remember, okay? So keep those information for at least 5 years. So record must keep for 5 years for the seniors people. If they're not seniors, you don't have to keep it for, it might be like just 3 years. But seniors, make sure you remember that 5 years. Senior, 5 years. Make sure you remember that. All right. And also, if you do have some other thing you're not sure about, you can go to the comment section and that under that video, then post it. Maybe I can review them and see if I can give you guys an update on those as well if you need more information. So let's talk about replacement. Now we're going to talk about the replacement. This is called the Florida replacement rule. This is a rule that set forth the requirements and procedures to be followed by insurer, which is insurance company, what we call the principal, and agents when marketing a proposal for replacing of a life insurance product. That's why they put that rule there, because people or agent was replacing people insurance policy for fun. It was not in the best interest. So the state of Florida say, hey, you can't do that because insurance never goes on sale. So don't just replace people policy. You know what I'm saying? Because people say, hey, yeah, listen, I just might you a good deal. No, man, yesterday was the good deal. So today price go higher because due to age. So insurance never goes on sale. Don't listen to anybody tell you. So be careful. All right, definition of replacement. It's any transaction in which an existing policy is, okay, so that's, those could be, they consider those things replacement. All right, so be careful. They might say all of the following are replacement except, or they might say which of the following replacement will apply to. So you have to be careful, one of those bullets right there. If the policy lapse in the person didn't make the payment, so the policy terminated. Surrendered, the person called the company and say, I don't want the policy, they surrender the policy. Or the policy was converted to a reduced paid up or continue as an extended term. That's called his replacement. That's somebody who have a whole life policy. Now they do a reduced paid up. And we talk about that, I think, in chapter 3. Okay, reduced paid up or it's an extended term. Okay, so that's considered replacement. So you have to make sure it's in the client best interest in order for you to do that. Also, if you have somebody that do reissue with a reduction of cash value, somebody that they reissue the policy with reduction of cash value. So that's called replacement as well. Or maybe somebody that do converted so that they get the policy that's converted so that either the amount of the coverage period or is reduced. So if they converted maybe to the amount or the coverage, that's considered replacement as well. Use in a financial purchase. If they use it into a finance purchase, so that's also considered replacement. So those are replacement. Make sure you know what replacement mean when it comes to that. Replacing insurer. The company that issues the new policy, that's called the replacing insurer. That's been the replacing insurance company. So that's what we call them. It's existing insurer. This is the company that's the company whose policy is being replaced. Okay, replacing insurer. That's the company that's gonna give the new policy. That's the one that's gonna assume the risk. Okay, now the company that's who the policy is being replaced, that's called the existing insurance company. Duty of agents. Now, and let me talk to you for a little bit. So now, when you're going to replace somebody's policy, so you need to make sure you provide the applicant a notice regarding replacement. Make sure you know that notice regarding replacement. Make sure you know that, teammates. If you are going to replace somebody's policy, you have to give them a notice. Signed both by the agent and the applicant. Leave a copy with the applicant. Also, remember that you have to obtain a list of all the existing policy or annuities that are going to be replaced. So if you're going to replace a life insurance, whatever, if they have 5 policies, you're going to replace all 5. You have to make sure you list all those policies. Leave copy of notice, all sales proposal, or the sales material that you use with the applicant. Also, you have to submit a copy of signed notice to the replacing insurer along with the application. So make sure you know those things, because any of those can be on your exam. They may say, which of the following they do they have the agent when you're basing a policy. So make sure you know how important this as well. So we're gonna talk about. Let's talk about duty of replacing insurers. So what about the insurance company? If we have to do something, what about them? They have the job they have to do. They have to notify existing. Now look at this word, notify existing insurer immediately of the receipt of the application of the policy replacement and provide a copy of the notice regarding replacement and information of the replacing policy. Now, no, listen to me. It didn't say that they have to wait for an approval from the other company. No, it said they have to just notify them. Hey, your policy, this client, looking for to change the policy that they have with you. So they have to notify them. So they can't say, oh, no, we need your approval. No, that's not what they say. Notify means just let them know that policy is going to be replaced at the minute you get that replacement application. The second bullet say, if requested by the applicant, send a comparative information form containing information about proposed policy within 5 working days of receiving the application. So remember those days, 5 working days. So those things, see, that's the easy number, 5. So if I have to take a 5 working days, so you know why, is because that's when they're talking about replacing insurance policy by the insurer. So they have that work to do as well. Okay. Provide a buyer's guide and a policy summary prior accepting the applicant initial premium, unless, listen, I told you, unless the policy contain a free look period at least 10 days. So there's a free look period for at least 10 days, you're good. So if you don't have it, now don't just walk around and say, oh, well, listen, Ernest told me if I don't have a buyer's guide, I can start selling insurance. No, if you have a 10 days, that don't just walk around and selling people. No, you bring your buyer's guide with you. Okay. But if you get your ones out while you're in the field, so you know when you deliver the policy, as long as there's a 10 days free look, then they'll be okay. They have plenty of time to review that policy and they can return it for a full refund. Make sure you know that. The next bullet is very important as well. Keep copies of replacement notices, statement, any sales material, and the application in the procedures file, producer file, for that applicant for at least 3 years. See, you got to keep it for at least 3 years. And I really believe, I'm assuming that for sure, if you was a senior, you got to keep it for 5 years. Duty of existing insurer. What is their job? So now, you, the agent, I give you your job, what you need to do. The company that's going to have the new policy that's going to replace the other company policy, you have your work to do. Now, what about the one that already have that client before? Now, what's their priority? What do they have to do? They have to provide the policy owner with a policy summary of the existing policy within 10 days of receiving notice and information that the existing policy is being replaced. So they have to let the policy, whoever owns that policy, they have to let them know in 10 days, your policy going to replace with so-and-so, with ABC company, insurance company, right? Keep replacement notification received for at least 3 years or until the next regular examination by the insurance department, whichever is later. Now, that's part of their work, not you as the person. So they have to make sure they do that, and they will. So products exempt from replacement rules. So there is not every, just like I was explaining earlier about this solicitation rule. So not every product that follow that guideline or the rule. So there's some products the replacement rule does not apply to. For example, industrial insurance. So the rule does not apply there. The replacement rule does not apply to credit life insurance. The replacement rule does not apply to group life insurance. You see those two already. The replacement rule does not apply to variable life or variable annuities. So you get those before. Or the replacement rule does not apply to a contractual change being made to an existing policy with the same insurer. So if you replace to ABC, if you're doing the policy with ABC company and you also do it with the same ABC, either you put the coverage more or less or the term, that's not considered replacement because you're doing it with the same insurance company. Now, you might violate, okay, churning at that time because you're doing it for a purpose of commission if that's what you're doing it for. So you might violate that rule. So you got to be careful on that as well. Also, existing policy, okay, is not, okay, the rule does not apply to existing policy in non-convertible term with 5 years or less left and the term cannot be renewed. All right, so make sure you know those things. That's important. We're gonna move along. We're gonna move right along to that. Okay, hopefully you guys taking some good notes. Now let's talk about Florida specific policy clauses and provision. Now remember when we were talking about provisions in chapter, I believe it's chapter 3, they talk about provisions. We're talking about things that standard that come with the policy. Those are standard. Okay, every policy issue in Florida must specify the name of the party in the contract. That's a provision. The subject of the insurance. The subject of the insurance. Risk insure against. What am I insuring that person for? Effective date and period of coverage. Premium payment or amount, conditions pertaining to the insurance, also form numbers and edition date of all endorsement attached to the policy. So every policy issued in Florida must have those things. So you know. Let's talk about the free look. Now, sometimes when I try to do it with this review, it's to help some people pick a couple points, how to break down some words as well. Not every word's gonna be like that, but you can. Imagine this word, you see this word, you never see it before, and that's the insurance term. It's a free look. What would you think of? So if something for free, that's mean I don't have to do anything for it. It's free. Then look mean, look, I'm looking right now. I'm looking at the screen. So that's mean I can look at it for free. Now, when you come to insurance, people, life insurance and annuity have a 10 days free look period in Florida. So you know. So that's mean if there's a 14 days free look, that's mean if I don't have the buyer's guide, it's okay. Because I have 14 days, the client can look at it for free. So that's when they can have 14 days. You don't have forever. Only 14 days to look at it for free. Then you can return it if you don't like it for whatever reason, and you'll get your full money back. That's what that is. Free look. 14 days, look at it for free. If you don't like it for whatever reason, return it. We'll give you all your money back. Good. That's a good promise. That's a good deal. That's when no risk to apply. Grace period. That's another word you can break down. What's the grace mean? Grace mean is something they give you where you are not entitled to it. It's a favor. What is a period? Well, it's a length of time. It's not forever. Okay? So now insurance have grace period. So the insurance company give you, a favor. They should have canceled your policy for whatever reason. They did not do it. So they give you 30 days, guys. Remember those numbers. 30 days. Okay? That's mean 4 weeks or 1 month, for God's sake. So you get that. 30 days, 4 weeks or 1 month. Grace period is required in the state of Florida. It's required to give them 30 days grace period. So if they don't, for whatever reason, intentionally, they didn't have the money to pay or they didn't have a chance to pay that policy, so they have 30 days, they still cover. But if they die, if it is an individual policy, they're going to pay them the face amount minus whatever they owe for that month. So Don't say they're not going to pay them. Don't say they're going to refund them the premium. Be careful how you answer that question. Insurers may impose an interest charge up to 8% of the number of days elapsing before the premium is paid. So, what does that mean? So, if you have that policy, you didn't pay for it, and you 15 days, you didn't pay for it. So that's when the insurance company can charge you up to 8% interest on those days. It's up to them. Okay? Because you didn't pay them, they can charge you interest. So you know. So make sure you know it's 8% during the grace period. Also, if the insured die, that's when if the insured die, that's when the client die, during the grace period, the death benefit is paid out minus any premium due plus the 8% interest from the death benefit. So it's a support. I'm telling you, some people say, I never see grace period on the exam. Man, you bet. They give you a scenario. Because remember, if the exam can trick you enough, you get to pay them another $44. So make sure they try to trick you, you trick them. All right. So make sure you read between the line. So if they're talking about give you a scenario of a client, who take an extended vacation for whatever reason, okay, they didn't have a chance to pay the premium on time, okay, so they were supposed to pay on the first of the month, so today already the 28th day, they didn't pay and they pass away. So what would happen? So they would pay them, it would just death benefits. So they would take the monthly premium plus the interest if there is any. Okay, so make sure you know that could be a scenario question for you. What is secondary addresses? What is that? It's to protect elderly insured. So some people, they're a little bit older. They might forget things easily. So instead of just cancel their policy, so the coverage, okay, for those age 64 or older, remember the annuity was 65. Now, just for general purposes, 64 and older, because considered senior here, for the secondary addressee, okay, that has been in force for at least 1 year cannot lapse for non-payment for the premium after the end of the grace period without notification of the policy owner, a second addressee, if provided by the policy owner of the impending lapse. Now, listen to this. Imagine you have someone that's older, 64 years old. So if they have a secondary addressee, then you have to let them know. Because why? It's because that person have an additional 21 days grace period. Remember, the original day is 30 days. So those folks, they give them another favor, another 21 days. So that's mean they have a total of 51 days. See, the 51 days grace period. Anybody who's 61 and older, they have 51 days before their policy can actually really lapse, terminated, because they give them an additional 21 days. Okay, so make sure you know that the grace period for somebody 61 and older. Policy loans. Now, policy loans. Loans, that's when there's interest you got to pay. So let's talk about this for a little bit here. So now, Florida laws specifies that insurance companies or insurer can charge no more than 10% interest on the policy loans. So they cannot charge no more than 10%. That's what the rule says. Now, anything less than 10 is great. They can charge that. Adjustable loan interest rate may not exceed the higher of either the published monthly average for the month ending 2 months before the date of the rate is determined, of the rate is used to compute the cash surrender value of the policy plus 1% per year. Okay, so make sure you understand those two bullets as well, because they might be tested. So another thing that we talk about, it was non-forfeiture option. I believe we talk about that in chapter 3 as well. Okay, if you have a chance to watch that video, the video for chapter 3, guys, make sure you do, go back and review it, because remember, if you don't follow the order of, you might miss some stuff. This is kind of more like a review of the 5 section that we did already. So non-forfeiture option, not give up my cash value. What my options, choices, okay? So the paid up non-forfeiture benefits become effective and the premium has been in default for at least 1 year unless another option is selected within 60 days after the due date of the premium. So that's when if you have the person, you know, for whatever reason, they didn't have a chance to pay the policy for at least a year. So unless they give them another option to select, I'm sorry, 60 days after the after the due date. So they give them 60 to make sure they can select something else. If the policy is surrendered within 60 days of the premium due date, after the premium have been paid for 3 years on ordinary insurance and 5 years in an insurer policy, the insurer will pay the cash surrender value. So make sure you know that. If the policy is paid up under the non-forfeiture benefits, the insurance company will pay the cash surrender amount if they surrendered within 30 days after the policy anniversary date. Also, insurer, which is an insurance company, can defer the payment of cash surrender for up to 6 months. So make sure you know that. You can request your cash value and they defer it for 6 months. Let's talk about spendthrift clause. What is that? Well, same thing. Everything there's protection. So we have a protection here. So if you see spendthrift clause, put protection for beneficiaries. Protect beneficiaries from claim of their creditors of the policy owner creditors. For example, let me just explain that a little bit because this could be a good subject here. Let's say that you owe XYZ company $10,000 or $20,000 or $50,000. Now, if you get an insurance claim, that's when you got money. So those people, let's say the policy owner, let's say that was my policy, for example, so you can get it better. It's my policy. Then I owe XYZ. Then I let Gene, the beneficiary. So I want to protect Gene from my creditors, so they don't go after the money, because if they see Gene, I left all that money for Gene, then I owe them, so they might want to go after that. So I want to protect Gene since he's my beneficiary, for the creditors not to go after. That's his creditors and also my creditors not to go after the money. So therefore, I put that clause in there to protect the beneficiary from claim of the creditors. Okay, is to protect beneficiary from the claim of their creditors. That's when their own creditors, which is Gene creditors as well, and also my creditors, so they don't go after the money. So it's to protect proceed still being held by the insurer, which is the insurance company, have not been yet paid. So sometimes what happened, the company hold the money and they pay a small amount of money, because if they pay them small amount of money, so they cannot see they have a lot of money. So that's the reason we talk about that. Okay, is protect beneficiary. So look, it also tell you not being paid to the beneficiary, such as in a case of a fixed amount or a fixed installment option. So it does not apply to a lump sum payment, because if they pay a lump sum, they would see you got the money is there. So they pay a small amount of money. Proceeds paid to the estate become part of the estate and are subject to creditors. So make sure you understand which clause that protect beneficiary. That's the spendthrift clause. Good test question for you. Designation of beneficiary. Designation. So who can I put beneficiary? Who cannot put? Who I cannot put as beneficiary? All right. So if the former spouse of the policy owner is the designated beneficiary, the designation will be void at the time of divorce or declared invalid by the court order if the designation was made prior to the divorce. So if people was married, they don't get married, so the beneficiary will be voided. So you know that. Make sure you know that. Life agent cannot be designated as beneficiaries unless the agent is placing coverage on a family member, what we call controlled business, which is cannot exceed 50% in 12 months. So agent, you cannot be beneficiaries. Bad luck, unless it's for your family policies. Policy settlement. Settlement of the policy must be made upon the death of the insured and proof of the receipt of death. So the insurance company will want you to show that the person will pass away in order for them to pay the death claim. If the settlement that's been settled down in a lump sum, if they pay in a lump sum, the payment must be included interest at an annual rate equal to the greater to the Moody Corporation bond yield average monthly average corporate has the day of the claim was received. So what does that mean? Just like if you do that claim, so the insurance company also had to pay the interest in while they were doing the process of the death claim. So a lot of company they will do that. So if the policy was covered for 150, don't be surprised they give you 150 plus another 500,000 interest or 400,000 interest or 200,000 in interest. It all depends how long it take them to pay the death claim. The insurer has the power to hold policy proceeds as agreed in written between the insurer and the policy owner. So if there is an agreement for the insurance company to hold the money, that can happen as well. The fund can be held in the insurer general account, because general account to make sure it's guaranteed to be there. An important aspect that we talk about is what we call competent party. So those are the party entering into the contract. The insurance contract must be legal age. So what does that mean, legal age? In order for somebody to be competent to get into the contract in the state of Florida, they must be at least 15 years old. Remember that we talk about that at believe in chapter 1. 15 years old. Mentally competent. They have to be mentally there. So if they're not mentally capable, they can't enter into the contract because they won't be able to understand the contract. And not under the influence of drugs or alcohol. So that person cannot be under the influence of alcohol. If the person was drinking alcohol, you see that was alcohol they're drinking, they're under the influence or drugs. So it's not be a good idea to sell them a policy. And also they tell you the minimum legal age to enter into a life insurance or an annuity contract in Florida is 15 years old. Now, to get the license, you got to be 18, but to buy the product, you have to make sure you be 15 years old. So somebody who's 14 is not competent. Somebody, now be careful. Somebody can be disabled, but they're competent. Be careful. So a disabled person can be competent. All right. So make sure you be careful. And you don't need a second degree. Go to college to get a degree in order for it to be competent. So be careful how they gonna try to trick you in the exam. Okay, prohibited provision. There's some stuff also that prohibited provision. Insurer may not issue policy in group according to age. Insurers, insurance company, they may not issue policies in group according to their age. Okay. Insurer may also not issue policy that contain annual endowment, such as founder policies or coupon bearing policies. Can't do that. Or the certificate of authority of any insurer who violate this provision will be revoked. So be careful. So now we're going to talk about another important subject is group insurance. I think we do talk about that in chapter 4, I believe. So let's talk about some characteristic of group insurance. Now, a group insurance now is where you find a group of people into one policy. Now, remember, for the person in Florida, for the exam, there's no minimum to consider a group in Florida. So one person can be a group. So the sponsoring organization, or what we call the employer, usually refer to the employer, they hold the master contract, which is they become the policy holder. There is one contract, every employee covered under that master policy. Now, those members, they receive a certificate of insurance that telling them that they cover under the master policy. So you know that. Individual coverage amount must be determined according to non-discriminatory rule, so they cannot discriminate. Group life insurance is usually written as an annually renewable term. So that's mean annually, every year, renewable term insurance. Rates and coverage are based on the group underwriting. So they take the whole group to evaluate the group, not one person. Evidence of insurability is usually not required if participant enrolled during the enrollment period. Make sure this is very important. So if you don't want to be tested, to do tests to show that you're in good health, so make sure you apply before that. Okay, this is an important thing here. So evidence, that's when evidence mean of insurability mean they do not have to provide that they're in good health. They don't have to do tests because when they do the group policy, as long as they do it during the enrollment period. Coverage amount over 50,000 are taxable to the employee. So if somebody go to a group policy, they buy $100,000 policy into a group. So the first 50,000 is not taxable. The additional 50 is taxable. If they get 75,000, so the first 50 is not taxable, but the 25%, then 25,000 is taxable. If they get 50,000, they pay no taxes. If they get 25, no taxes. Because as long as it's below 50,000 is not taxed, but above anything more than that, the difference is taxable. Group must be exist for the other person just buy insurance. You cannot just do a group because you don't buy insurance. A group of people who say, listen, since we cannot qualify for insurance, let's create a group so we can buy insurance. That you can't do that. And also the group must be in existence more than a year. Okay, individual coverage without evidence of insurability should they leave the group. So also just like I just mentioned that point, so the group must be there more than a year. Number of members required to form a group. Florida law requires that group plan must be provide coverage no more than one person under the group policy. So that's when one person is good, but there's some special group. Okay, eligible group. There's some group that needs a number. Employee group offered to both active and retired employee. A debtor group. To be eligible, the group must be at least 100 new person a year. So make sure a debtor group, make sure there is a number 100 in order for them to qualify. Labor union group must include all of the members of the union. So if there's a union, everybody got it. Trustee group. The trust in the policy. The trust is the policy holder. Now, 2 or more employer union join together to provide a benefits to their employee. That's called a trustee group. Association group must have at least 100 members as well, just like the debtor group. Must be an active existence for at least 2 years. So now the association group must be at least there for 2 years. Okay, have regular meeting at least every year. Now, credit union group policy must be issued for the benefits of all eligible members of their credit unions. So that's why you want there's sometimes you go back, you do a bank account into a credit union. Sometimes they offer you a free coverage because they give it to everybody else. They put you inside a group. Or the group receiving special approval from the department can also be part of it. All right. So there's some good stuff. Good stuff. Now, listen, I also got to let you guys know at any minute, if you want to take a break, just pause the video, take a 5-minute break, 10-minute breaks, and after you come back. So even though the video might be continue, but you can take as many breaks as you want. You can watch this video as many times as you want. If you like the video, you can share it to somebody that you know that might benefit from it, that want to learn and pass the exam as well. So we're going to talk about another subject here. Florida require provision. So now the state of Florida requires grace period for 31 days for group policies. So if you have a group, 31 days. If it's a regular individual policy, it's 30 days. So make sure. Why is 31 days? Why they didn't keep it simple? Well, they just want to make the exam a little bit harder. They put 31 days for the group. Incontestability period, 2 years. They can contest against someone if they lie into the application. Make sure you know that number, 2 years. Entire contract, representation versus warranty. So now a copy of the application must be attached to the policy, okay, in the entire contract. Statement on the application are representation, not warranty. So you have to know representation that believed to be true, warranty as guaranteed to be true. So any statement made into an application for insurance in Florida, they consider representation, not warranty. Insurability. Insurer reserve the right to require an applicant to provide evidence of insurability as the condition to the coverage. So if they ask you to prove that you're in good health, hey, you please do so. Now, another concept, people probably understand, oh man, why would you do that? That's a lie. Misdemeanor of age or gender. Listen, if that happened, they're gonna either adjust the premium or the benefits will be adjusted if the age of the insured has been misstated. So when somebody misstatement of age or gender, put next to your notes, make it right. They will just fix it or fix it. They will fix it according to their real age. If they're still living, the premium will be adjusted. If they already pass away, the death benefit will be adjusted. It could be go up or down. Payment of benefits. Death benefit must be paid to the beneficiary designated in the policy. So whoever the beneficiary gets to collect the money. Certificate of insurance is the insurer issued the policy holder, okay? They provide each insured an individual certificate of insurance. So when you get a group policy, people think they get their own policy. No, you don't. You get a certificate that say that you are part of the group. Conversion or termination of eligibility. Each individual has the right to convert. That's when you can convert from a group to an individual policy without evidence of insurability within 31 days. So now you don't have forever. Now this is a short period of time they give you, 31 days to convert to your own policy if you no longer working for that company or you get fired for whatever reason, or it doesn't matter what happens. So as you're no longer there, you get 31 days to convert that policy, which is most people forget about it, which is just funny after something happened. Then they say, oh man, Kali, I wish I convert my policy because now I cannot qualify for a policy. But anyway, so let's talk also about conversion of termination of the policy. Let's say the employer or the sponsor plan, the organization decided, oh, we're gonna cancel it. We don't need, we're not gonna provide that benefits to our employee anymore. So if the policy itself is terminated, every insured who has been covered at least what? How long I said? 5 years. If you've not been working covered for at least 5 years, you're not on it. And the dependent, okay, is entitled to convert the policy. Now that's different. That's the terminate the whole plan. So if you just there for 4 years, you're out of luck. 5 years you have to be in there in order for you to be able to convert. Death benefits. Death depending conversion. So what happens if the person died during the conversion? Well, if the insured died during the conversion period before an individual policy become effective, well, the claim is payable under the policy. So that's why you see sometimes somebody might be sick and they ask the hospital and their family say, hey, let the person go. Because what happens is if the 31 days pass and they're gonna be in trouble because they have no insurance and they probably could not qualify for something, and their family really get into a bad situation at that point. So that's why we encourage people, make sure you really take a good look of what you are making the decision when you, that's why those things are important for you to know when you're buying insurance. So if you die during the conversion, so as long as that happened, you get full death benefits since it's a good plan. If you're an individual, they will take the premium out. Conversion privilege. Must convert within 31 days. So we explain that. So if some policies, good policy, they have a conversion privilege. So that's when you can convert 31 days, you can convert to individual policy. Can convert to any type of individual coverage except term. So every time you convert, you're gonna be a whole life policy. So make sure you know that. When you're talking about the conversion, you're gonna convert from term to a whole life. You can convert from a whole life to a whole life, but you cannot convert the policy to another term. Proof of insurability is not required. So of course, as long as you do it in 31 days, you don't have to prove that you're in good health. The face amount will be the same as the group, okay, coverage, but the premium will be higher since the individual policy will issue based on their attained age. That's what most people don't realize when they have the group plan. So if they work for 30 years and they convert 30 years from now, you'll be 30 years older. So the policy can be very pricey. So make sure you be careful how you understand this. So the premium will go higher. The face amount is the same as the group, but the premium will be higher because it's going to be based on your age at that time. Coverage of dependents. Group coverage must be extended to include the employee, spouse, and also dependent children. So they can also do that as well. The amount of coverage for the dependent may not exceed the amount of coverage of the insured employee. So you cannot, if you cover for 25,000 into the group, you cannot say, oh, my wife gonna put for 50. That ain't gonna happen. So there's a really restriction on those things. Assignment of the proceed. Individual assignment. Remember, when you see with assignment means transfer, okay? Transfer of ownership. The individual covered under the group policy may make an assignment to all or part of the incident of ownership, including, but not limited to, ownership, conversion privilege, and naming the beneficiary. So when you have the group policy as well, you can also assign it to someone else, full ownership or part ownership. So remember, there's two assignments: collateral assignment, absolute assignment. Collateral mean you give the right to someone else, you can never get it back, but you still become the insured. But collateral assignment, I mean, sorry. Absolute assignment, you give the right away, you cannot get it back. Okay, it's done. It's a done deal, but you still the insured, you cannot get it back. Now, collateral assignment is when you use it to secure a mortgage or maybe some debt. So now once you pay the mortgage or the debt, so you can get your policy back. That's why you call partial ownership. You transfer part of it to someone else. So collateral assignment, absolute assignment. Collateral, partial right. That's when you still own the policy, part of it. Absolute assignment, you give it away completely, you cannot get that back. So I think that's pretty much that for this section. So hopefully that did help you guys out. There's this chapter, I think probably 15 or 20 questions. I'm not sure. 15 questions most likely. I'm not sure, maybe 10 or you have to check to see how many questions are on there. So make sure you take good notes and you can review that, and maybe that will help you pick a few points on that exam. That'll make a big difference for you. I wish you the best. I wish you success. And if you have any other things that you're not sure about, just let us know. Then we'll be more than happy to talk to you about it. All right. Thank you, teammates, for listening to my crazy talks. All right. See you in the next video. Bye-bye.